Good afternoon, everybody. Hello to all our investors. This afternoon, we've got a very exciting webinar for you. We are focusing on one of the new Feldman equity deals called the Pinnacle Corporate Park. With me this afternoon is Lyndon Booth. Lyndon is part of our investment committee, and Lyndon is also head of Global Marketplace. So welcome, Lyndon.
Hi, Rian, great to be here and so excited to see Larry and the team again. I'm such a great fan of Feldman Equities, and I think this deal in particular is really exciting. So very excited to be here.
And then we are literally on holy ground tonight with Larry and Mac Feldman with us this evening. So Larry and Mac, welcome. It's a privilege for us to spend the next time with you.
Thank you very much.
And maybe just for our investors who do not know Larry and Feldman Equities. So Larry Feldman is CEO and president of Feldman Equities. And Larry's been CEO and president of Feldman Equities since 1990, if I'm not mistaken.
Right.
And in terms of Feldman Equities, as Lyndon has said, we are so excited to work with an institutional quality sponsor. Feldman's got a 30-year track record, and over this 30 years, Feldman Equities has managed, developed, and acquired 11 million square foot of property, equaling to a value of $3 billion US. So to our investors and the attendants or the participants, you heard us right, it's $3 billion US, and that makes Feldman Equity a tenured sponsor on our books. So let's call it a prime sponsor. And Feldman's niche or speciality is to acquire commercial property, do creative renovations, and then turn around those properties and lease up the tenant profile. So Larry, over to you. As we've said, we are focusing on the Pinnacle Corporate Park. If okay with you, Lyndon and myself will ask you questions as we go along. And then for the participants, welcome to you. If you have any questions, you can post your questions in the question and answer section or in the chat section. So thank you, Larry. Over to you.
Thanks very much for that introduction. So let me give a little bit more detailed background on the company, and then we'll get into more detail on the property that we're offering today. I have been in the business, as you just mentioned, for about 35 years. And during my career, I was both the chairman and CEO of two publicly traded REITs, which were traded on the New York Stock Exchange. One of these was called Tower Realty Trust, and the other was Feldman Mall Properties. We've been involved in both ground-up development, meaning we're building buildings from the ground up as opposed to renovating existing buildings. And in addition, we've been involved in the renovation of Florida office buildings since 1985. Currently, we're the largest privately held owner of office buildings in the entire Tampa Bay area, with a portfolio in excess of 2.3 million square feet. We specialize in acquiring older buildings in the best locations in the state of Florida. We're only in Florida, we're nowhere else. And following each acquisition, every building undergoes a transformative multi-million-dollar renovation. These are not just casual paint and brush jobs. We transform almost every part of the building. These renovations typically include completely new lobbies, all new bathrooms and corridor renovations, all new elevators and often all new elevator systems, new energy efficient air conditioning, and new lighting systems. One of the key trends that we established here in Florida is the inclusion of tenant amenities. Our amenities include high-end fitness centers, common boardroom facilities for tenant meetings, what we refer to also as 24/7 chill zones. These are soft seating areas that often have game areas and areas for cocktail parties. And we also make sure that all of our buildings have healthy restaurant choices at the ground floor. So here are some of the photos. These are some of my favorite photos of Pinnacle Corporate Park, which is a 2-building complex that we're going to go into more detail on. And we can just flip through these slides so you get a sense of what the property looks like.
Larry, if I can just interrupt there. So am I right to say then that since Pinnacle Corporate Park is A grade, investors' money will be very well spent, in the sense that money will go directly into these renovations and improvements that you spoke about?
That's right. A significant amount of the initial capitalization and of the equity raise that we are doing here is helping to provide a $6 million fund that, together with a lender that we are doing a loan facility with, will provide the capital needed to do the renovations.
Thank you.
So here is the agenda for the webinar. First, I'm going to talk about the elephant in the room, which is the impact of COVID-19 on office buildings and what the future of office buildings will be, in our opinion. I'll talk about a little more detail about our team, a little bit more about our track record, and also the Fort Lauderdale office market, where the property is located. And then we'll drill down to the very specific real estate itself, which is called Pinnacle Corporate Park, located in Fort Lauderdale, Florida. So here are some of the key members of our team. We have a very deep bench of seasoned real estate experts. These folks know how to lease, manage, and finance office buildings. So we're completely vertically integrated as a company. We can do all facets of the business. And you can find out more information about our leadership team on our website at feldmanequities.com. That's equities, IES at the end.com. I know a lot of you must have questions about how we are, as a sponsor, are dealing with COVID-19 and what our outlook is for the office market. So let's get right into COVID-19 and how we view the future of office space. So first, it's helpful to understand the background of office space over the last 10 or 12 years or so. Following the 2008 recession, which was a watershed event here in the US, employers discovered that they could reduce office rental rates, office rental costs, by jamming more and more workers into less and less office space. The technical term for this is called densification, meaning you're getting more employees into less office space, thereby saving per capita cost for office space. I refer to this as the sardinization of America that has occurred over the last 10 years. And this was all happening pre-COVID. So now with COVID, everybody now is saying, oh no, we have to take these people and space them much further apart. So we think that this trend of densification that was like a 10, 12-year trend will completely reverse in a dramatic way due to social distancing. So while many employers are talking about a hybrid model, virtually nobody is saying, I'm going to give up the office entirely. They're talking about a hybrid model where employees may spend up to 2 days a week at home, perhaps, and 3 days in the office or something like that. And by alternating shifts of staff, a lower total number of desks may be needed. However, the reduction of office space attributable to the hybrid model by sort of what we call hot desking these desks, meaning you don't have an assigned desk, you just come in to the office and you get the desk that's available that day. That economy of space may be completely offset by the fact that desks need to be further apart. So we don't necessarily think that office space is actually going to decline in need. Google's Eric Schmidt believes that the demand for office space will actually grow as companies will need to spread workers out to prevent the spread of future pandemics. So let's also talk about attitudes towards office space and how even in the last 6 months, these attitudes have changed dramatically. So here is an incredible statistic from 2 recent KPMG surveys. I laugh every time I see this statistic because it actually reveals a lot about what's happening in our industry. In August, just this past year, in August of 2020, KPMG found that 70% of CEOs plan to shrink their office footprints. The same survey that was conducted again just this past March, about less than 2 months ago, about a month and a half ago, now finds that only 17% of CEOs are saying that they're going to shrink their office space. So that's the same company, KPMG, the same analysis, only spaced in time, maybe 6 or 7 months.
So Larry, have you applied your mind to why there's a shift in that mindset? Is it due to the lack of human interaction? Is it due to Zoom fatigue?
I think that's definitely part of it. And let me just kind of give you a personal story that might put it into perspective why I think this shift is happening. Recently, in 2020, I was personally quarantined in my home, and even our closest friends didn't want to come see us. My wife and I are not, kids, so we have friends that are our age, and I was starting to feel like Tom Hanks in that movie Castaway. Did you ever see that movie?
Yeah.
If you remember, Tom Hanks had a volleyball that he called Wilson. And because he was all alone, had no social interaction with people, he began talking to his volleyball. If you remember, screaming, "Wilson, Wilson." So the reason I'm talking about Castaway is that I think it's actually instructive about the future of office space. And it answers your question, because in my case, I was actually starting to lose it a little bit. I wasn't completely off my rocker, but I really was feeling more and more isolated as time went on. And if you remember that movie, Tom Hanks had all of the food and shelter that he needed. So it wasn't the physical survival that he was dealing with, but he was actually not surviving. And so the point is that people need to be together. We are social creatures. So we think that once the virus abates, which it is a big time here in the US right now, vaccinations are flowing throughout the country. We think that the social imperative, so to speak, is going to far outweigh the fear. And we're already beginning to see people returning to the office. And then it's interesting to see the tide shift. At the height of the pandemic, many companies indicated that they would allow employees to work at home potentially indefinitely. Now, that's all beginning to reverse. A lot of the major CEOs like Jamie Dimon of JP Morgan Chase and Bezos of Amazon, they're all realizing that this is not the way to operate. And speaking of Amazon, this was a direct quote from a blog. You can get it online if you want to read it. I'll just read you a few lines from it. This is directly from Amazon. It's a worldwide blog that was issued about a few weeks ago. Many of you have been asking for guidance around when we will return to the office so you can better plan the next several months. our plan is to return to an office-centric culture as our baseline. We believe it enables us to invent, collaborate, and learn together most effectively. Over the past year, our teams have done incredible work under difficult circumstances, and we've learned a lot about the pros and cons of remote work. We now look forward to the day in the not too distant future when we can again invent together safely and in person on behalf of our customers. So even as COVID has generated all of this talk about work from home, we're now seeing a big swing and a big shift to get people back to the office. And Goldman Sachs, by the way, same thing. We want people back as soon as possible. Jamie Dimon is citing the fact that young workers who are recent hires are completely lost at home. They have no mentorship. There's nobody able to bring them into the fold, so to speak. The old way of operating was that a more seasoned veteran boss would mentor a young student. You just can't do that on Zoom. But also, I think it's important to note that Florida, and specifically Southern Florida, is a big beneficiary of headquarters relocations as companies in New York and other mass transit dependent cities where people are still a little concerned about getting on a subway car. These cities have seen an exodus into Florida. And we think that this trend is only going to accelerate because of the tax law in 2017, which basically made the higher paying tax states like New York far more expensive. So we've seen a mass exodus from these high paying tax states like New York and Illinois and even California. We're seeing in-migration into the state of Florida. So that's also offsetting any weakness we think that might come from COVID.
Larry, can I ask you about that? Because I'm curious. One of the things we always look for in a sponsor is someone who's in a state that's growing quickly. And our current understanding, I think, is that Florida is the seventh quickest growing state in the US in terms of population. I think it's something crazy, like over 1% per year in terms of its population growth.
Right.
And that was there before COVID hit. Do you think COVID's accelerated that? It's interesting, we're seeing a trend in some other parts of the world where populations are moving away maybe from the big cities like New York, London to other centers. Has COVID, do you think COVID's going to help Florida's growth rate to even accelerate more than it was before COVID came along?
I think so. The talent that we have in Southern Florida is really amazing. Directly across the street from the property that we're talking about today, the headquarters of Citrix is located. So now Citrix is a multi-billion-dollar tech company, not a household consumer name, but a very large tech company, by the way. They employ a lot of talent. And now that talent, now with COVID, theoretically, they could be in New York or they could be in Florida. And the cost of living in New York versus Florida is night and day. You can still buy a home at half the cost or a quarter of the cost that you would pay in New York, except for some of the most extreme cases in Miami, there are in Palm Beach. The state of Florida, as a general matter, is one of the cheapest places to live in the state in the United States. So where the mobility of workers now has increased due to COVID, where anybody can work anywhere, you're now seeing a tremendous influx of people into the state of Florida. But we believe that even as they moved here, we're seeing that these young people still need to congregate and want to collaborate in an office. So they're choosing to live here because the quality of life is far better, the taxes are far lower, the cost of living is far lower than it is, let's say, in New York. And So for all of those reasons, COVID has sort of accelerated that mobility, I think.
So Larry, and also I reckon industries like advertising, IT, they will always demand office space, since they need to be together to be innovative, if I can put it like that.
It is so true. I see that in my own office all the time. Things that happen in person in a meeting or a spontaneous hallway meeting, and the camaraderie and the esprit de corps, just the morale of being around people is completely different than it is on Zoom. I don't know what it is, but Zoom is a cold way of interacting with people. There's just no substitute for personal interaction, and the spontaneous things that can happen sometimes in a 3-minute meeting can change the whole course of a company. Not as likely on Zoom.
And before we step off this, I think just for our participants and the investors listening, I think you're making a very significant point that COVID could actually create an opportunity that the square foot per capita might increase. So we might get more rental per square meter, if I can put it like that, because we don't want to be sardines anymore, kind of thing.
Good point. I agree with that. So let's just move on to getting into a little bit more of our track record. If you flip to the next slide, we can just show you history here. It's a little bit difficult to read on this slide, so I'd recommend that your viewers get this on their own screen and perhaps take a deeper dive rather than me drone on and go on to all of these buildings. But you'll see buildings that we've acquired going all the way back to New York City when we were at one point a New York-based company. We, like a lot of companies, began moving to Florida in the 80s and became exclusively a Florida-based building, office building owner following the year 2000. So you're free to please go on our website and find that track record information at your leisure. And just a little bit about how we operate as a company in terms of how you can monetize your investment. In some cases, our strategy for exit will involve a recapitalization where we may offer investors the right to sell their interests to a new incoming group of investors, where we may offer a new syndication, say 5 years from now, hopefully at a significantly higher price, to a new group of investors. We'll offer all of our investors the ability to stay in the deal or to take cash and exit, or some mix thereof. In other cases, if we don't do a recapitalization, we may sell a building outright if the price is right, or we may refinance the building, and sometimes we're able to take out surplus cash from the refinancing, which, by the way, at least according to US tax rules, you have to check your own country rules, is a tax-free distribution. So that's another way of at least partially monetizing your investment. Flipping ahead, we'll get into some case studies. Just quickly, this building is Morgan Stanley Tower, which is located in downtown St. Petersburg. We acquired this building in 2013. It was only about 65% leased. And we actually spent $10 million in capital to renovate and reposition this building. That's 10 million in US dollars. And now the building is, I would say 97% leased. We've significantly increased the net operating income and probably are on our way to almost triple the initial valuation over the next year or two. We certainly doubled the valuation. Wells Fargo Center is another building in downtown Tampa that we acquired in 2012. We bought this in joint venture partnership with Goldman Sachs after begging them to come into the deal, by the way, for about 6 months, because it was still a very troubled time following the '08 recession in Florida. But we paid about $44 million at acquisition. We recently recapitalized the building at over $88 million. Our new partner now is New York Life Insurance, and we expect significant valuation improvements from here. By the way, Goldman Sachs was very happy with that deal. We actually moved their quarterly earnings, and were featured as one of their best deals of 2015 when the building was sold. All right, so now let me get into the specifics of Pinnacle Corporate Park. And let me start out by talking about the most important thing, which is, you've heard it before, location, location, location. That's the most important thing with real estate. Pinnacle is located in the city of Fort Lauderdale, and this location is in the heart of Florida's largest metropolitan area, consisting of both Miami and Fort Lauderdale. That's considered one metropolitan area according to the US statistical area. It's a 6.2 million person statistical area, and it is by far the largest statistical area in the state of Florida, by far, Tampa being number 2 at about 3 million people. So Miami, Fort Lauderdale, about 6.2 million people. And over 1,000 people a day are moving into the state of Florida. So given the fact that Fort Lauderdale, Miami is the #1 center in the state, and it's the #1 job producer, we get a significant percentage of that 1,000 people a day of in-migration. And then what's interesting about the exact location of Pinnacle is that it's about midway, roughly, between Miami to the south and West Palm Beach to the north. So this is a location which enables our tenants to service all of Southern Florida from one location. So unless you have the ability to open up multiple offices in multiple cities, if you want to cover Southern Florida, this is the location to be in, because it's in the epicenter of all of the population. Now, more specifically, Pinnacle Corporate Park is located in what we refer to as the Cypress Creek submarket. And you can see that with this red star on the map. And it's located just about 12 minutes north of downtown Fort Lauderdale by car. Some people refer to this as Uptown Fort Lauderdale because it's extremely densely populated, densely built out, over 20 office buildings in this Cypress Creek submarket. And we think that this submarket is a huge beneficiary of corporate relocations coming from the Northeast. Many of the tenants in the building are ex-New Yorkers, like myself, by the way, who are now living in the state of Florida, and they're bringing their companies with them. You know, the old stereotype about Southern Florida was that it was South Americans buying up these condos, and there's still some of that, but it's now mainly domestic US buyers buying into the market and bringing their companies with them, not just 80-year-old folks looking to retire, but younger 50-something billionaires moving down here with their entire company. A little bit more on the location is that we are right on Interstate 95, which you can see from this next slide. We are right on Interstate 95, which is by far the most important roadway in Southern Florida. And we are adjacent to the Tri-Rail commuter station. So we have a train station literally facing our property right on our parking lot. And also, notably, the building is, as I mentioned before, immediately across the street from the world headquarters of Citrix, which is a multi-billion-dollar publicly traded tech company, highly respected. Microsoft also has a very large regional hub nearby. IBM has had a presence here in Southern Florida for about 40 years. A little bit more on the location is to talk about the exodus of companies on tax differential. I mentioned this before. With the passage of the 2017 tax law, we're seeing very wealthy entrepreneurs realizing that if they're in the state of New York and they're paying 9% roughly state income taxes, and a few percentage more for New York City, they're up in personal basis up around 50% taxes. In contrast, we have no city tax and no state income tax, and the real estate taxes are comparable. So it's a way cheaper cost of living. And as you probably know, Fort Lauderdale has been known as a tourist destination and a community for wealthy retirees. But as I mentioned, the trend is really changing, and it's now becoming younger, and it's now becoming much more corporate. So,
Larry, sorry if I can just jump in there.
Sure.
So one of the things is the old story in real estate of supply and demand dynamics. So since Fort Lauderdale is such an elite area, you've mentioned that it's quite densely populated in terms of office buildings. So I assume that the risk of oversupply coming on market and driving down, the exit prices and so on is quite a small risk.
That is a good question, and that is something that we always look to two issues. First, as you mentioned, is the supply that is coming down the pike a threat to our investment? And what is our purchase price per square foot relative to the new cost of new construction? In this case, it's check the box in a good way on both of those points. So there is no new product either planned or under construction in the Cypress Creek submarket. There are some very expensive, very high-end buildings being delivered recently in 2020 in downtown Fort Lauderdale that rent at literally 40% higher rental rates that don't really compete. If you want to be in downtown, you will go to downtown and pay $50 a square foot. If you want a high-end quality office building, perhaps closer to your home, closer to the water, and closer to the highways where more employees can access your office, you'll come here, have luxury, beautiful office space for $35 a square foot. So that gives us a significant competitive advantage in terms of rental rate. And that's a function of the fact that we're paying $225 per square foot to buy the building. So $225 per square foot compares to almost $400 a foot to build it. And even after we get done with all of our renovations, we'll be at a cost basis of $250, $260 a square foot, fully renovated, fully leased, all the tenant improvements loaded into that number at a very significant discount to today's replacement cost. The number I'm giving you of $250, $260 a foot is several years forward after we've fully gone through renovation and added in millions of dollars of new tenant improvement dollars to lease to new tenants. So down the road, we think that $400 a foot might be more like $450 with even modest inflation. And our cost basis of $250 compares very favorably. So does that answer your question?
Yes, it does. And also just following on to that, apart from buying lower than replacement costs, the fact that you're doing these innovative renovations, I assume, apart from increasing the value of the property, it will also increase the rental per square foot that you can add on apart from normal inflation-linked rental increases.
That is a very good point, and it's interesting. The way we view that is that the main purpose of our renovations, day one, is to drive occupancy. So one of the things we love about this deal is that it's only 83% leased right now. With our renovations, we expect to drive up occupancy and take occupancy into the 90s versus the low 80s right now. That additional revenue is almost all profit because we are basically paying all of the operating expenses to operate the building and keep it open now. So the vast bulk of that influx of additional lease up is all profit to the bottom line. And that ultimately will drive up value because the higher the net income, obviously the higher the valuation. Now, with respect to rental rates, ultimately we will see a bump in rental rates. We're assuming by projection that's going to happen after our renovation, perhaps more like a year to 2 to 3 years out, as opposed to immediately. And that's fine because it will leave more meat on the bone for the future buyer. If we want to sell the property, the new buyer will say, oh, with all these renovations, I can, when these leases expire, I can get a higher rental rate. Therefore, I'm going to pay the partnership more money to buy the building. So the rental rate bump will occur, but it's not all immediate. The main focus of the renovation is to drive occupancy and drive net operating income up, which drives up value.
Thank you.
Larry, if I can, I got a quick question on the price you paid. That sounds like really good value. Has the general price been impacted by COVID in the sector? Is there much distressed assets around, or is actually not really?
I scratch my head, Lyndon, because in fact, it's, you know, that I think there was a little bit of a lull here when we entered into this contract, and but generally, I don't see that pricing has come down at all. You know, although pricing should have come down, you might say, due to COVID, what's also dropped during the past year are interest rates. These are the lowest interest rates in my lifetime. Our debt in this deal is going to be in the 3s. For most of my career, Lyndon, I've never even dreamed of debt in the 3s. So I think that's counteracting a lot of the possible drop that you might have seen or the distress. Now, if you own a hotel in downtown San Francisco, you've been hit pretty hard. But even that has not really been like a flood of, you know, product coming on the market in distress. Generally, there hasn't been much distress. A lot of investors are looking past the point of COVID. We are now in a really facing a full recovery here. Even New York City, which, you know, people counted out for dead, looks like it may be coming roaring back to life. So, although the cost of taxes is so high, I still would bet on Florida.
Larry, great answer. It's interesting how around the world with many of our partners, you know, there was this expectation that perhaps there would be price drops, but with the government actions in the key countries we deal with, the interest rates dropping, it has nullified it. And what's actually interesting is, I think pretty much like the other markets, it's expected to be a pretty good few years ahead with the interest rates where they are, and a good opportunity now to get into real estate, because I think there's good upside coming.
And Lyndon, that's part of our strategy. We intend to lock interest rates as fast as we possibly can here for the very long term. We actually think that if we do get a big round of inflation with all the printing of money that's going on, that our debt may become, instead of a liability, it may become an asset. You know, we've talked about this before, that in effect, that happened in the 1970s in the US, where people had locked in sort of pre-inflation at 4% interest rates, and then we wound up at 20% interest rates. And so they were paying back the mortgage with pennies, inflated dollars on pennies on the dollar, but their interest rate was fixed. My dad used to do 30-year mortgages, so we're looking to do at least 10, and maybe in some cases we can go longer, and we will.
Larry, sorry, Rian, I know you wanted to say something, but probably about 5 years ago, if I'd heard about that you were getting 3% and 3% plus debt rates, I would have wished that I could leverage a bit off your brand and reputation to go and get my own 3% loan. But the good news these days is I don't have to, because I can invest directly with you, who is getting that. And you will do a much better job of the investment than I will. So, very grateful for the company I work for. That means I don't have to go and do this myself. I can get both the benefit of the interest rate, but also the expertise of people like yourself. I don't have to try it myself anymore.
Thank you very much. I appreciate you saying that.
Larry, also just in terms of following on Lyndon's question, in terms of especially the Cypress Creek submarket not falling as much, does the front office nature, of the offices in that area, and especially Pinnacle, play a role in that?
Is your question whether the front office versus back office, is that the question in terms of?
That's correct, because my understanding is that the Cypress Creek area is more a front office based office space, and hence, let's call it the office, the size of the office space at Pinnacle plays directly into that kind of demand and type of office space.
That's a great question, and it's a good point, which I forgot to cover, so thank you for asking it. There is the possibility that with COVID showing employers that certain people can work from home, there is the possibility that some of those people working from home are, let's say, I don't want to be disparaging or use pejoratives, but let's say not high intellectual value employees, that they may be more like call center people that just answer the phone all day. Those people do not necessarily need coworkers to collaborate or invent together with. So we think that the back office type office building may get hit a little more than the front office. This particular property is the exact reverse of that. It's all front office. It's all very high intellectual capability with engineers. We have our largest tenant is a company called Vertiv, not a household name, but also publicly traded NASDAQ listed company, VERTIV. They are a tech company that actually does a tremendous amount of business with Citrix, who's located directly across the street. It's all very highly paid engineers. This typical salary at Vertiv, I would guess, is $150,000, $200,000 a year. These people need to work together and collaborate. In contrast, a call center person could work from home. We're not going for that market here in Pinnacle. The submarket, the Cypress Creek submarket, is a luxury front office tech, and by the way, very important financial center. We have Transamerica Insurance, big finance company, U.S. Bank. This area is also having a nickname now, and it's being called Wall Street South. These high-end finance companies, hedge funds, really are not going to develop new hedge fund strategies by working from home. They want to be in the office and collaborate.
Thank you for that.
Sure. So the slide that you have up right now is showing the train station, the proximity. The buildings are shown, the blue and the white building are the Pinnacle buildings. We'll flip ahead to the next slide and talk about the fact that the age bracket is also dropping. You can see the lifestyle of this living is conducive to a lot of nightlife. We're seeing a lot of millennials moving in. So the stereotype you may have of Southern Florida, of people walking around on walkers and they're 80-something-year-old. It's all changing. A lot of millennials moving in. The lifestyle is a 24/7 beautiful lifestyle. Flipping to the next slide, there is a very interesting potential. This slide is interesting. I mentioned this before. The new buyers are all younger, as opposed to the old stereotype of South Americans buying. Flipping ahead to the next slide, this is a very interesting upside that we expect could happen. We are not putting it in any of our projections, but we have actually 14 acres of land here, which is being wasted right now in the form of big on-site parking lots. If we were to take these red dotted areas, which you can see on this slide, and build structured parking, replacing the parking lots with built-up parking, we could create one or more building sites for other office buildings or apartment buildings. This could add a significant amount of future value to the real estate, but we are not putting it in our projections. Flipping to the next slide, this is just providing a little more detail about the property. So Pinnacle is a pair of Class A office buildings, and it's consisting of 260,000 square feet total. That is consisting of 150,000 square feet in an all glass building, which was built in 1986, and a smaller building of 110,000 square feet, which was built in 2001. So we have two buildings, one of 110,000 feet and one of 150,000 feet. Both buildings are characterized as Class A buildings. They are known as one of the best buildings in the submarket, if not the #1 building in the submarket of Cypress Creek. No tenant is more than 12% of the total square footage. So that provides a lot of protection. Let's just talk about what I mean by protection. As we look at this next slide, let's keep in mind that buildings that are dependent on tenants that are, let's say 100,000 square feet, let's say a 200,000 square foot building that has two tenants of 100,000 square feet, that's a very dangerous investment. The landlord could actually be facing foreclosure if just one of those tenants move out of the building. In contrast, like I mentioned, our largest tenant is only 12% of our rent roll. So there's no likelihood of a house of cards happening from one particular tenant. And our average lease term, if you take all of our leases in place, and the average maturity is got 4 years to run from the point of acquisition, which gives us quite a bit of cushion. So a little more detail about what our plan is to lease up the property is we have hired the best in the market leasing agent to lease the property. And we are aligned with this leasing agent where we actually are sharing equity with the agent. So they actually will be a partner, and that's on our side of the ledger of the equity. And we'll be paying these brokers in the Fort Lauderdale market a 25% brokerage commission premium above all other sponsors, and we will be paying them faster than all other sponsors. And we have successfully employed this strategy for over 30 years, where we outpay our competitors on brokerage commissions, and we pay them faster. We've also budgeted a substantial amount of marketing dollars, which is focused on this brokerage community. So we're constantly hitting them with promotions and gifts. Literally every couple of months, we send them a small gift with the name of the property on it and the phone number to dial and the website to go on to. And we have assumed a substantial war chest of leasing capital dollars for tenant improvements, which will give us a war chest for leasing during our anticipated 5-year holding period. Flipping to the next slide here.
Sorry, Larry, before you flip, that's such an interesting slide. If you can just go back one for me, please. Also, apart from the fact that a single tenant only makes up 12% of the property, I think if I look at the industries, technology, financial services, business services, there's quite a nice diverse spread of industries as well. So the vacancy is not dependent on an industry doing well.
That's a great point, and thank you for making it. The broader the diversity of your tenants and the variation of lease expiration dates, and the more numbers of tenants, it's better to have smaller tenants and a lot of them with different lease expiration dates. So that adds a lot of protection, so that if you are in a soft market like we're in now, you can get into a much better market, which we are anticipating, let's say the second half of this year, as people are now returning back to the office, they're beginning to lease space again. But if we go through a pocket like this again, when we have a lot of numbers of tenants with different industries, we are much more resilient to the next downturn. Never bulletproof to downturns, but let's say there's safety in numbers.
Then my final question on this slide is maybe just from an investor risk perspective, or a potential investor risk perspective. The average lease term remaining is 4 years, but the investment term is 5, or let's call it the anticipated investment term is 5. Can you maybe just discuss Feldman's approach to limit that risk in terms of tenant renewals and so on and so forth, please?
Sure. We're in the business of leasing up vacant space and turning around office buildings that need a tremendous amount of, let's say, that are already good buildings, but need a jolt in the form of renovations. And one of the things that we do when we do that is we engage the new incoming tenants and say to them, hey, we're going to give you a brand new build out. We build in a big tenant improvement budget into our upfront capitalization, but in exchange, we want long-term leases. So with respect to all of the new incoming tenants, we may give them a large tenant improvement inducement to come in. We may give them a significant amount of free rent as an inducement, but we are going to get back long-term leases. So that is one way we expect to push back lease term. Then with respect to our existing tenants, we will be immediately meeting with them. And my son, Mac, who is really a fantastic asset manager, he has already been meeting with virtually all of the tenants and really finding out what they need and want. And what we will be doing with them is working towards finding ways of getting them to extend their lease term. So in some cases, that may actually involve, some cases, somebody downsizing a little bit, giving up 1,000 square feet, but we'll say, okay, we'll do that for you, but we want you to push back your right-sized space to a longer lease term. Hopefully, many of the tenants, because of the strength of the Florida market, are expanding, and as part of the expansion, we'll get a long-term lease extension. In some other cases, where there's neither an expansion or contraction, we may go to them and say, hey, we'll upgrade your space, make it more beautiful, paint, carpet, new offices, but keep it exactly the same size, but give it, and we'll give you some free rent just as an incentive, but we want you to extend your lease. The more we can do that, the more we extend leases, the more we lift up the value of the building, because the future buyer will look at the stability of the cash flow and the strength and longevity of that cash flow as a big value improvement. And that's what we're really in the business of. We're in the business of leasing up vacant space and stabilizing existing cash flow and making it more appealing to the next buyer owner to buy that.
And then Larry, just lastly, in terms of your cash on cash or targeted cash returns and IRR, at what vacancy rates did you model those expected cash on cash returns and so on?
It's in the low 90s occupancy, about 93% stabilized. So we're only talking about going from 83 to 93. Obviously, if we exceed those projections, we can increase cash flow dividends. But our dividends are projected based upon a low 90s occupancy.
Thank you.
So going forward and talking about some of the tenants, Vertiv, Pipeline, and Jacobs Engineering are our three largest tenants. Vertiv and Jacobs are both publicly traded. I talked about Vertiv before. Very large publicly traded tech company, and Jacobs Engineering is one of the largest engineering companies in the United States, also publicly traded, considered really one of the best engineering companies in the country. Pipeline is a privately held tech company that just traded to a private equity company for $1.6 billion, all employing, by the way, highly paid engineer tech type employees. Flipping ahead, just talking about Vertiv's lease. Vertiv's lease expires in 2030. Jacobs expires in 2027, and Pipeline expires in 2026. Flipping ahead, these are some additional shots of the building that are sort of my favorite shots, showing the interior of the building. This is a night shot that I really like. You can see this is a true Class A luxury office building. Now, this is actually a plan of what we intend to invest in the building. As you can see from this chart, it's a total of $2.7 million in renovations, plus about $500,000 in what we refer to as ready to go or spec suites. So it's $2.7 million in capital renovations, and then we'll spend another $500,000 in making tenant suites beautiful, plug and play, ready to go spaces, even with furniture, by the way. So a company who's been sort of waiting to get out of COVID now can come right in and immediately move in to our buildings. And it really has shown that when we make these spaces beautiful and make them like brand new, that they lease quicker. The scope and details of our renovations include a brand new lobby upgrade in one of the buildings, an all new conference center, a high-end fitness center with all new equipment. This is the kind of fitness center you would pay $50 US a month to occupy. We give it basically for free to our tenants. And a 24/7 chill zone where tenants can actually sit and have a cappuccino or play on a shuffleboard game or a beanbag game or have a cocktail. These are the kinds of things that we do in our buildings to keep tenants in our buildings and attract new tenants, and particularly attract millennials that love the fitness centers and love the lifestyling of these play zones and chill zones. So let me talk a little bit more detail about the renovation. The 550 building is a little bit, the two buildings, one is very modern looking and very up to date, and the other is a little bit dated. This is the 550 building, which is the smaller of the two buildings. Our plan is to modernize the entryway. And to give you an example of what this looks like, we're going to show you another building that we own that we recently syndicated. This is the existing condition before renovation. This building is actually, that front will be under construction very shortly. That's the existing condition. And now I'll show you what that exact location will look like post-renovation. And if you look closely at the front entrance doors, you'll see it's all glass. if you flip back to the prior slide, you can see it's all cluttered up with metal and things that obscure the entry. If you flip to the new entrance, you can see an all glass look. And what we're going for in all of our renovations is the concept that when you walk into them, you believe you've walked into a brand new building. That is one of the key end products we go for. All right, let's give you another example here. This is our Park Tower building, 1970s construction, downtown Tampa, great location, but a building when we bought it was tired, had not had a lot of reinvestment into it. And what you're seeing is the before renovation shot. This is the next slide here, the after renovation slot. You can see that we gutted the entire storefront from end to end. And that's the inspiration. This preceded the Sarasota renovation, and Sarasota precedes the Pinnacle renovation. You can see that by putting in this all glass storefront, the look and feel is as if you have walked into a building that was built in 2021, even though it's 1973. All right, these are examples of our fitness centers. This is a signature element in all of our buildings. We like to build these beautiful fitness centers with first-class equipment. We invest over $100,000 of equipment in our capital budget for upgrading, for actually creating these fitness centers. Go ahead. All right, so this is the total capitalization of the purchase. You can see that in terms of how we're going to source the cost of the purchase and all of the renovations, $48 million is coming from debt. Initially, that'll be $42 million. We're going to have a additional loan facility for tenant improvement dollars and capital improvements of $6 million for a total of $48 million out of the 68. So $48 million of debt, $68 million of total sources, the delta being equity contribution, which is coming from a combination of different components of limited partners and $4 million of sponsor equity. So the sponsor equity in this deal is roughly about 20% of the total capitalization of the 20% of the equity of the 19 million, 4 divided by 19, and about 6% of the total capitalization.
So Larry, if I can just jump in there, that's one of the reasons why we approved Feldman Equities, as a sponsor, is that you've got skin in the game with our investors, and not a 1%. It's quite a significant capital investment. Then just one thing that I want to ask, you've mentioned previously that you've got quite a fat marketing budget, but I don't see it here. So is that funded from the lender portion?
It's funded from cash flow. We have budgeted at least $100,000 in year 1 and 2. By the way, we use that money extremely pinpointed. The total audience for that is about 100 real estate brokers in the area in Fort Lauderdale, maybe 125. We each year at Christmas time will buy gifts as expensive as Pelotons for our top producers, and that's included in that budget. We'll send them a little small gift every 2 months. We're hosting events that are just for the real estate brokers that are very elaborate, beautiful events. But because we focus it so intensely on just those 100 people, we can afford to be very extravagant with that $100,000 budget.
So I think there's 2 things out of this slide for me, is that investors do not need to worry that any equity contribution will go into marketing, if I can put it like that. It's a result of cash flow, as you mentioned. And secondly, you as the sponsor co-invest about 25% of the equity raise.
Correct. So looking at the uses here, the purchase price as I said before, is $226 a foot. That compares to almost, I would say, $400 or $400 per square foot or higher of replacement cost. So that's one of the reasons we love this building, to be able to buy an existing building in a market like this, with this much growth, where you know eventually there will be new construction, although we think it's still 3, 4, 5 years from now, when rental rates are much higher, because rental rates have to get to somewhere around $45 or $50 a foot from their current levels of about 35. This is on a gross rent basis. They would have to grow to about $45 or $50 a foot to get to that level to support new construction. So that's one of the things we really love about this deal. The TILC, these are real estate acronyms: tenant improvements and leasing commissions. That's the war chest that we need to lease up the vacant space. Capital improvements that I've mentioned before, $2.7 million. In the $3.3 million is the $500,000 of ready-to-go spec suites that we referred to before, that we will build out immediately. That's an extremely high priority to make these spaces sort of plug and play with furniture. We're putting in, by the way, some really cool open kitchens now, right in the middle of the space, like you would see in a very high-end European condo. We're putting these beautiful kitchen islands right into the space with laptop areas that you can hang out and, sip on a cappuccino while you're working, right in the middle of the tenant space. We put that in as part of that spec suite, and it really lifestyles the space, makes it very appealing. Then there are various financing fees, and then we have reserves. We build a war chest of money to just have for a rainy day fund as part of our initial capitalization, and other closing costs in there. There is also an acquisition fee of 1% to the sponsor in that $2,458,000. So estimated going in net operating income 3.7. We're projecting that when we push occupancy up following our renovation, we expect that renovation to move occupancy up into the low 90s percentile of occupancy. The bulk of that delta between 3.7 and 5.4 will be through lease up, although, as you mentioned before, some of that will be from rental rate appreciation. We expect an exit cap rate of 6.5%. We expect that $6 million, which has been committed to by our lender, will be funded over time to fund the cost of tenant improvements, leasing commissions, and capital expenditures. And that's how the loan gets to full size at $48.5 million. We're projecting annual inflation rates of 3%. And by the way, we're only growing our rental rates over our projection by 3%. We're assuming a $1 increase, which is about a 5% increase following our renovation. But if you look at where replacement cost rents need to be, ultimately, the growth rate, could be materially higher. We just don't like to project those rental rates closing that gap, but that is a potential upside in the deal.
Yeah, especially since you've mentioned earlier, that other developments in South Florida, there you're looking at $50 per square meter. So that's almost like the gap.
Per square foot. Yes.
Yeah.
Sorry, we use a very antiquated, feudal method of measurement.
Yes, sure. Yeah, no, true. Thanks for that. So I'll park it in the back of my mind, not to create confusion.
Sorry. All right. So that pretty much wraps up our financial analysis. Let me get into, mention the cash flows for the annual cash flows. We're projecting for the first 4 years about a 6.5% dividend. once we get all through the stabilization, we expect cash flow to really jump and stabilize. So we may hold the property if we think cash flow is really surging and we want to continue to hold and enjoy that cash flow, or we can turn that cash flow over to the new buyer who will pay a premium for it. That is showing in year 5. Your average cash flow is 7.5%. I'm sorry, 6.4% is the average. The targeted number is 7.5%, and the overall return is 15.7 IRR. Now, these are all returns before factoring in overseas taxes and other costs. These are how we projected for the U.S. market. Overall,
Yeah, so
a
just thank you.
1.96 multiple.
Yeah, so just thanks for that. So just to the participants, you can go to your platform for the after tax and after fee return if you want to place that in context. Can I just ask you 2 questions on this? Can you just discuss your cash flow strategy, in terms of year 1, year 2, where you use the lender's money, and then you create excess cash flow to apply in year 3 and 4, and that's why we get this big jump in year 5. If you can just go through that for me, please.
That's all very well articulated. That's exactly the strategy. Initially, the cash flow will flow to the bottom line because there will be no drain from the cash flow from tenant improvements because we have this large loan facility. Towards the roughly mid 3rd year of the cash flow, that lender facility runs out, and now we use cash flow to fund tenant improvements and leasing commissions. There are some lease expirations in those years. We are anticipating that we may have additional dollars to fully stabilize the building, to utilize that strategy that I had mentioned before, which is to get our tenants to push back leases, get all the vacant space completely leased. Once we get all through that period, then we get into a beautiful coasting period where we have very little reinvestment in the property and it's all cash flow. That's where you see that 11.7% cash flow. And that could continue stabilized for quite a few years into the future.
So thanks for that. So I think one thing to the participants and the investors, once again, they shouldn't be fooled. The fact that year 1 to year 4, the targeted cash returns stay around about 6.4, that there's not an increase in net operating income, or that we don't have an increase in rentals. It's just how you basically build up reserves so that you can have a kitty for year 3 and 4 to keep the rentals at a specific level, which then minimizes our risk in terms of the 4-year lease term versus the 5-year investment period.
Exactly correct.
And then, Larry, just my last question on this, and it's not on this slide, but there's something called a minimum return of 8%. If you can just place that in context as well to the investors, please.
Yeah, this is probably one of the most important things. If you are just beginning in investing in commercial real estate, I would advise you to be very cautious about investing in a deal that does not have a preferred return to investors, because some sponsors basically say that from day one, the sponsor gets sort of a carried interest, which is really not based on profit. It's just based upon an arbitrary allocation to the sponsor of 20 or 25% of the future profits from day one. Our deals say that we, as the sponsor, do not get any promoted equity or carried interest until 2 things happen. 1, all equity is fully returned to the investors, and B, an 8% preferred return to the extent it has not been paid from cash flow. So let's say we only pay out 6.4 in year 1, you will accrue 1.6%. And then that will be paid from the proceeds of a sale, that accrual, like almost like it would be on an interest on a loan, although it's not technically a loan. Then once that 8% is fully paid, and that's, by the way, compounded, 8% compounding per year, then with respect to surplus, after everybody's gotten back that 8%, then we get 25% of the profits. That structure is very different, where a developer sometimes gets 20 or 25% of the profits from day one. Basically, you're investing in a deal when you do that, where you're getting 80 cents on the dollar from day one, which is really not a good deal for an investor. So I would strongly advise any real estate investor who's just starting out in investing to make sure that he gets a priority return of equity and preferred return before the developer makes a carried interest.
So
That's how my deals have always been structured with our institutional partners. You know, we're partnered right now with New York Life. We've had partnerships with Goldman Sachs, Dreyfus Realty Advisors. These are big institutions. That's how they demand how developers deal with them. We've carried that out into the public syndication in the same format. So I would be very cautious again about investing in any other format.
Yeah, so I think a key point there is also that all equity holders have the same rights in terms of that equity component. But then apart from Feldman putting equity in with our investors, there's also that preferred return before you can earn that additional or start sharing. So I think that's also very important, where there's an alignment of interest with our investors.
Agreed.
Right.
All right. So that concludes the financial section, I believe, of the webinar. This is just a sort of a summary of why we like this deal. And there are about 7 reasons why we like this deal. First, as I've touched on throughout the webinar, we're going to create value through renovation, pushing up occupancy and ultimately pushing up rental rates, all of which pushes up bottom line and increases the value of the building. Over the last 24 months, the ownership has completed 17 leases totaling 91,000 square feet. So the rent roll has been bolstered, and there is a 4-year average lease term remaining that gives some safety in the investment. The property is located in a very densely populated area, midway between Miami and Palm Beach. It's the best location to service all of Southern Florida, and it can ultimately have the possibility of an apartment or potentially other office building development onto the parking lot. We've given no value to that in our projections. The property is 82.9% occupied, and so we think there's a lot of upside in cash flow by driving up occupancy and market rent. Pinnacle has been resilient. This is a very important fact. I actually think I forgot to mention it during the webinar. All through COVID, and COVID was quite the test for the credit worthiness of the tenants, the collections were 100%. There were no delinquent tenants during all of COVID. So some competing properties with weaker credit tenants, they have tenants that are maybe unable to pay rent. Those tenants, those buildings may have suffered more. Pinnacle has a much higher degree of credit worthiness of tenants because of that point you asked about before. This is a very high-end front office tenant market. It attracts big companies looking for high-end space. And by the way, they could be companies like Transamerica coming in for a small branch office. The Transamerica is one of the largest life insurance companies in America. So the property is being acquired at a big discount to a replacement cost as a developer, having built from the ground up. this is something that really gets me excited. And I've talked about that a lot during this webinar. And then the access, the highway access of immediate Interstate 95, the most important roadway in Southern Florida is Interstate 95. By the way, for those that don't know the US road system, it runs directly into New York City from Miami all the way up to New York City. And it's why so many New Yorkers have settled down into Miami, is Interstate 95. We are right on it, and we have the railroad station exiting directly onto our property. The station itself is right there. So we love that access. So that's a summary of the deal. At this point, I will open it up to Q&A, to any questions your investors might have. Happy to answer any questions.
Larry, before we hand over, and I think, Lyndon, we've basically answered most of the questions in chat. I think one thing, about that railroad as well, or the rail station, as well as your ample parking space, it also limits that COVID-19 risk, because a person that doesn't want to go on the railroad can get in his car, he can have ample parking, and so that addresses that as well. And can I say, given the location and your neighbors, you've mentioned Microsoft and so on and so forth, it gets me very excited about the potential exit, because we can, well, not we, Feldman, can target maybe a big institutional buyer like an insurance company, a pension fund, and so on and so forth, that could ease the exit strategy in terms of the property. Is that a correct comment?
Not only is it a good theory, it's real, because the owner previous to the one we're buying from was Northwestern Mutual Life Insurance Company. For those overseas that don't know Northwestern Mutual, it's one of the largest life insurance companies in the United States. They owned the property for 20 years. They originally developed the property, so they are a classic example of an institutional owner. And this, we refer to this property as institutional grade real estate, which is a different category of, you have Class A, and then you have sort of institutional grade Class A, which is sort of an uber Class A category. The only thing it lacks really are these amenities that I mentioned. It's just, it needs a little bit of jolt in the form of fitness center, conference center, some lobby upgrades and things like that, just to bring it up to 2021 and hopefully even to 2025. But we do think once we complete those renovations, it will yet again be attractive to institutional ownership.
Larry, yeah, so I think there's no more questions. So just before we close, just for our investors and the participants, the Pinnacle deal is open on platform up until the middle of June, the 16th of June. And Feldman was so gracious to provide us with capacity of $500,000 US. We hope we will exceed that. So from that point of view, the investors can go onto the platform and they can just have a look at the deal, but just keep in mind that it's closing on the 16th. So Larry, from my side, from Lyndon's side, and from all the participants, we've taken up an hour and a half of your time. To you and Mac and your team, thank you very much. It was a very interactive, very informative session. And once again, thank you very much. And we are proud to be associated with an institutional quality sponsor like Feldman Equities.
Thank you so much. Great hosting job. I'm going to take you on the leasing roadshow if you don't mind. You're doing a great job.
It's easy to be inspired by a quality deal.
Thank you very much.
Okay, so thank you very much and have a very, very good evening.
Thank you. Bye-bye.
And a day to you. Thank you. Thanks a lot.
Thank you. Bye-bye.
Thank you. Bye-bye.